All right, good morning and welcome to another exciting lecture of economics. So we're going to start this section. So we're starting macroeconomics. Micro is done, and that was completed, I think, with the midterm. So we are starting with the second half of economics, which is macroeconomics, which will be dealing with just more the bigger issues that you hear about: interest rates, recessions, unemployment, national debt, currency. All those things that you usually see in the newspaper are usually issues of macro. So let's get started, and I will share my screen right now. Okay, so now with macroeconomics, we are dealing with the aggregate level, which is the total level of spending, which is or total level of demand, which is all the players in the economy and what they demand in the economy. So that is called aggregate demand. And we're going to equate that to all the supply or the nation's total output, called aggregate supply. So once again, you know that we're moving to a graph, but instead of supply and demand of certain goods, we're talking about supply and demand of all the goods and services in the economy. So once again, some of the macro issues that I mentioned, these are the macro issues that we will be dealing with: unemployment, inflation, fiscal policy, monetary policy, national debt, taxes, recessions, and etc. So our first lecture, I would say, is our building block of macro, which means that unfortunately I need to go through terms, what they mean, in order to build our model. And I think it's also important that some of these terms now will probably show up in the business section of the newspaper. So if you so choose to get a better understanding of some of these concepts, I would really encourage you to start listening to the business news, because you'll start to get accustomed to the language of these newspapers and how some of these concepts are being applied in reality. So I would say in macroeconomics, and when we're dealing with, government policymakers, you have two main players in our economy that tries to manage the economy. And one is the government of any country. Whenever they set different policies to try and help the economy, it is called fiscal policy. And any type of policies coming from the central bank. All countries have a central bank. So in Canada, our central bank is the Bank of Canada. And anytime the policymakers in the Bank of Canada tries to change things to encourage spending or reduce spending or change the course of the economic health of the economy, it is called monetary policy. So I would say that the two main issues our policymakers have in terms of economy management are prices, because change in prices up or down can either lead to inflation, which is not good for the overall health of the economy, because when there is, uncontrollable inflation in the economy, people's purchasing power will fall, and households will notice or experience, a decline in their real wealth or purchasing power. Deflation is bad for the economy, and I'm not going to go into that much detail of deflation, but it basically means that prices are falling, and when output prices are falling, that means business owners will notice a decline in their revenue. When revenue declines, then they're not able to hire as many people. Employment will decline, and whenever unemployment increases in the economy, you're dealing with spending issues because households are not likely going to spend when they see that their income is in jeopardy. The other issue that most policymakers will deal with is output, or what we call economic growth, or economic stagflation, or economic decline. So we'll be dealing with how an economy measures output today. We will deal with how the economy measures prices in the next lecture. So moving into how our economy measures output, and we use the term GDP. So right here, we have two measures of national output or income. And in macroeconomics, most economists tends to talk about income and output in the same fashion. We actually say expenditure, which is output, is equal to income. And I'm not going to go into a huge amount of detail with how that gets equated, but I have included a video, and it's called the Circular Flow Model Explained. So moving on here, the way most economies or most countries measure income or output is by something called GDP. And I'm sure you've heard this term before. It's a very, it's a term that is, used often in business newspapers. You hear this term when we talk about, what country is the largest economy in the world, and they usually use GDP. So I'm going to go through an example of how we calculate GDP. So what we have here is we have GDP and we have GNP. So GDP is defined as your gross domestic product, and it is defined as the total value of all final goods and services produced in a country over a given year, and it is valued at current prices. So when we talk about final goods are what we define as goods that do not become other goods and sold again. So final goods are goods that are bought and used and never ends up being resold. So a good where it is made into something and resold is called an intermediate good. So I'll just give you an example here. Let's say you go to Costco and you buy a bag of flour, and you take that home and you make cookies, and you give those cookies out to a friend, you eat them yourself. Those cookies, the bag of flour that you bought from Costco would be considered a final good. Now, if you were a baker and you bought that bag of flour from Costco, and that bag of flour you turn into bread or other baked goods, which you then sell to your customers, that bag of flour would be considered an intermediate good. Whereas the bread or the cookies and the baked goods that you sell, which really came from the bag of flour that you bought from Costco, that would be considered a final good. So our economy we use two types of measurements for our economic health. One is, like I say, our GDP. The other is called our GNP. Now, our GNP differs from our GDP because it is a measurement of income and not output or expenditure. So GNP is a superior measure to GDP as a measure of economic well-being of domestic residents. So the biggest difference between GDP and GNP is that GDP is a great measure of economic activity within a certain country. So let's say that you're looking at the output or production of all the goods in a certain country. Whereas GNP is there to measure income acquired by domestic residents in Canada, as well as Canadian residents that lives in a different country. So let's say if I were to decide to teach for a year in, say, Thailand, I would report my income back to Canada and pay Canadian taxes. My income that I earn in Thailand will show up in Canada's GNP. Even though I am making money outside of Canada, the fact that I pay Canadian taxes and I am still a Canadian resident means that any income that I acquire outside of Canada, I still need to report it. And that shows up in Canada's GNP. I'll give you another example in terms of in terms of the difference between GDP and GNP. So let's say you decided to buy a hamburger, and let's say you're living in Vancouver right now. So let's say you decide to buy a hamburger from McDonald's. So that transaction, that hamburger shows up in Canada's GDP because that output was produced here and that expenditure, that transaction was completed in Canada. So that hamburger that you bought at McDonald's will show up in Canada's GDP. However, McDonald's is a US corporation, and the income from that hamburger eventually will show up in the McDonald's corporation as income. So that transaction will show up in the USA's GNP because McDonald's is a US corporation. So any multinational corporations, any type of income that they acquire from other countries will show up in the GNP of where that country lives. So if you bought a Toyota in Canada, that transaction will show up in Canada's GDP, but it will show up in Japan's GNP. Okay, so I just want to give you a bit of a difference between GDP and GNP. All right, so the measurement of GDP is usually done by Canada's or our government's data collecting agency, which is Stats Canada. Stats Canada collects data for many types of applications. They also collect data for employment, consumer confidence, sorry, not consumer confidence, consumer price index. So they are the data gathering agency of our government. Okay, so how does StatsCan calculate output? Well, like I said before, through our circular flow model, we can calculate either GDP from the output or expenditure side, which means that we are there to calculate everything that people have bought in that year. Now, what we tend to do for GDP is we don't just put them all together. We actually look to see how much was bought from the different sectors of our economy. So therefore, we look to see, number one, how much did households buy that year? How much did businesses buy that year? How much did our government buy that year? And how much did our trading partners buy from us? And how much did we buy them from them? And that would be our net exports. So we tend to calculate GDP broken up into how much are different sectors, how much did they spend that year? So we have our household consumption, which we call consumption expenditure, business spending, which we call investment expenditure, government expenditure, which is spending from all levels of government. So that includes municipal government, provincial government, and federal government. And like I said, lastly, net exports, which is basically exports minus imports. And that is how much our trading partners bought from us and how much we decide to buy from our trading partners. So one thing to note here, one caveat in terms of business investment or investment spending. Investment spending is mainly business spending. So it would be businesses investing in new equipment, inventories, new buildings. However, the one caveat is that new homes purchased by households would be considered investment expenditure and not consumption expenditure. So what you have here is you have net exports, and that is the value of the nation's export minus her imports. So what you have here is you have consumption, government purchases, investment spending, net exports, and that is an example of how we calculate GDP from the expenditure side. So how do we calculate GDP from the income side? And what we have here is we calculate all the income acquired by Canadians domestically and abroad, and we add these up. So income would be in the form of wages, corporate profits before taxes, rent, interest, indirect taxes. So indirect taxes are excise taxes. So whenever you go out and you buy something, you have GST and PST. Those would be your indirect taxes. CCA is called your capital cost allowance, and that is the same as depreciation in accounting. And we minus subsidies, because subsidies was income that was never earned. It would be an income. It would be some monetary gift from a government agency. So once again, you add this all up and you're going to get a total, and that is how you calculate GDP from the income side. So here we have expenditure should equal our income, output should equal income.